So hello and welcome to the Move into Thailand and Early Tax Planning webinar. Here we'll help explain the rules if you are looking to move to Thailand or you've just moved to Thailand regarding the tax rules. My name is 𝗬𝗲𝗏 and I'm the co-founder of Expat Tax Thailand. After my accounting degree, I passed 31 professional examinations in trust and tax from UK, Chartered Institute of Insurance, Hong Kong, Thailand, and the USA. So Expat Tax, we're a Thai tax filing licensed accountancy company. We've helped thousands of expats with their Thai taxes, and we've got nearly 600 five-star reviews on Google for the way that we work with individual clients. We're authorized and regulated by TFAC, which is the Federation of Accounting Professions. All of the accountants and tax consultants are English-speaking Thai nationals with decades of experience with both Thai tax, UK, US, and a lot of EU countries as well experience. So what are the main worries that I see from people that we see from people that are looking to move to Thailand or have just moved here? These are some of the common things that we get asked. Will I be double taxed? I'll explain what this actually means and what are the safeguards against this. We get a lot of questions about, will the tax in Thailand be higher than in their home country? So we'll explain this as well. And we get a lot of people asking, is the paperwork onerous? Is there a lot of paperwork to do? Which there's not. It's only an online client portal that you need to fill out. And we get a lot of questions around Thai banking rules now, common reporting standards and the access to data that the revenue department and the banks can see, and also FATCA reporting. So see, these are some of the common questions that we get and some of the common misconceptions that we see and misunderstandings that are really important if you are moving to Thailand is, compared to other areas of tax, moving to Thailand, I feel, is one of the key areas we can really help people is plan before they move, because they can make some mistakes that could cost them with high amount of tax that they don't really take into account. So I do recommend, I'll go through these common misconceptions, but I do recommend, if you are considering moving to Thailand or you've just moved or you're about to make a big financial decision like in cashing in investment, pension, or sell a property, just get in touch. Free 15-minute call. We can help you understand the rules because it can be quite complex and each situation is different. So misconceptions that we see. So we see a lot of people that sell the main residence in a Thai tax year. So they live in another country, sell their main residence, and because it's not taxed in that country, they misunderstand that it's not taxable in Thailand as well. It can be. It depends. We get a lot of misunderstandings about retirement lump sums. So this term is different in different countries. So when people retire, they can receive, in some countries or some situations, a lump of money, a chunk of money from their pension that's not income. Now, a lot of people misunderstand that this is, because it's not taxed in their home country, that it is not taxed in Thailand. So it's important to consider this. Investment capital gains. So a lot of people that move to Thailand don't realize that investment capital gains is not since the date that you arrive in Thailand, it's all-time capital gains, which is a real big misunderstanding that we see. And also one of the key ones, which is on one of the questions we've had today, is on the date of arrival and tax residence. I'll explain this, but it's not the day that you arrive. It's actually the calendar year. So I'll explain that. So if you would like free consultation, there's many ways you can reach out. There's a link in the description on the chat message. Also, here is a QR code. All you have to do is take a picture on your phone and it will link direct to the booking page. So feel free to take advantage of that. So today we'll go through the Thai tax rules for 2025. Who needs to file? We'll explain a little bit about double taxation agreements and what are the common allowances and deductions that everyone gets. What are the implications if you don't file, and moving to Thailand tips that we can offer. So then we'll get into the questions as well. So what are the current rules? So the current rules are the same as 2024. There's been no change to the foreign remittance rules. The domestic cryptocurrency rules have changed with the crypto capital gains tax for 2025. And we'll have a webinar to follow, but this is only for domestic Thai crypto exchanges and not for international. So regarding most people that are looking to move to Thailand or have just moved to Thailand, the rules are the same as 2024. So there have been quite a lot of rumors that they are going to make, the revenue department are going to make some changes to the Thai tax rules. Nothing's confirmed. There's nothing published in the Royal Gazette, which is the way that things, become official in Thailand. So unless there's anything published between now and the end of the year, then we'll follow the 2024 tax rules. I do recommend that you subscribe to our YouTube channel because we update on there with any important updates we put onto there as well. And also, if you're watching the recording, if you're watching this live, then you'll already receive our tax alerts. But if you're watching the recording, feel free to sign up to our tax alerts on the website. And then any future changes will keep you updated. So what are the tax rules and what's actually the current rules? So they actually changed for the 2024 tax year. And what the changes were, it's been published in the Royal Gazette, and there's quite a lot of information about this from the Revenue Department about how foreigners living in Thailand can pay tax. Thailand is a remittance tax basis. What does that mean? It means if you are a Thai tax resident, which is 180 days or more in a calendar year, then if you remit, transfer, or spend foreign source income in Thailand, then you have to file a Thai tax return. This affects everyone in Thailand, whether you are on a marriage visa, retirement visa, DTV, LTR visa, it's all the same. You all have to file a tax return if you remit in foreign sourced income. So who has to file? Let's talk through this. So if you have domestic income, that means things like rental property in Thailand. You have a property that you rent out, or you have a Thai salary, you have to file a Thai tax return. Also, if you stay for 180 days in a calendar year, so 1st of January to 31st of December, doesn't mean consecutive, just through the year, then you are a Thai tax resident. And then it means, then it looks at what have you remitted to Thailand. So that means anything that you've transferred, anything you've spent on a Visa, MasterCard, anything that you have withdrawn from the ATM. If it's from sources like overseas pensions, income, dividends, things like investment capital gains or rental income, or you sell a property in that tax year, then that needs to be filed on a Thai tax return. I say it's quite complicated. Feel free to reach out. We can discuss your own situation. So if you are 180 days or more in Thailand and you remit foreign source income, like I mentioned before, even withdrawing money at the ATM, if the source of the money is income, it needs to be filed on a Thai tax return. So what is taxable income? Like I mentioned before, there's 8 different categories on the revenue code, section 40 of the revenue code. So everything on there from pensions, salary, dividends, investment capital gains, rental property income, seller property. It's all within there. What isn't taxable? So let's talk about this. If you move to Thailand, then the cash balance from the previous year is not taxable in Thailand. So your savings, prior year savings. So 31st of December, the year before you move, that's the value of your prior year savings. And that money can be remitted to Thailand if you can show that it was not earned in a Thai tax year. For investments, it's different. If you have investment portfolios, then this rule doesn't apply. It's all-time capital gains. If you sell and remit to Thailand, you tax on the gain. Also, if you receive an inheritance, it's not taxable in Thailand unless it's over the threshold limits. If you have things like civil service pension, military pension, US Social Security, it's not taxable in Thailand. It's exempt under the double taxation agreement. certain loans and gifts, but it's quite complicated. And if you don't stay in Thailand 180 days or more, so you're under the tax residence threshold and you remit foreign income into Thailand, it's not assessable income. But again, it's good to look at your own situation. There's not one size fits all with this. So tax year is the calendar year, as I mentioned, 1st of January to 31st of December. So for the current tax year, 2025, you need to file a tax return if you do have a tax filing liability by the 31st of March next year. So there's a 3-month lag period between the time we're at the end of the year and when you need to file. We do actually have a tax guide. So in association with the Learning Institute for Everyone, which is a Thai university recognized by the Ministry of Education, we've put together this collaboration to explain the Thai tax rules. You can download the guide. There's a lot of useful information in there. It's the official expat guide for Thai tax. So let's talk about double taxation agreements. So the first question on there was, am I going to get double taxed? We get that question a lot. Double taxation agreement overrides the local domestic tax rules. So if something on there is stated it's not taxable, then you can remit that into Thailand. The purpose is to set out clearly how certain types of assets are taxed. So we have to look at the double taxation agreement for not your country. It doesn't matter where you're from, your nationality. It's where your assets are situated. So for example, me being from the UK, if I have a pension in Singapore, I don't look at the UK Thai double taxation agreement. I look at the Singapore Thai double taxation agreement. So that's a really important point to note. So we've researched the 61 double taxation agreements. It's on our website. All of the information is on there. And we have done 8 or 9 webinars specifically for double taxation agreements for different countries. So from Germany, Netherlands, all the usual suspects, US, UK, Australia, Switzerland, Canada, South Africa, Sweden, and we've got more to come, including France. So if you would like to look at this, look on our YouTube channel. We've got all the videos on there to explain specifics. Now, once you've remitted in, if you stay in Thailand 180 days or more, and you have remitted in, so transferred foreign sourced income, and you need to file a tax return, and let's say the double taxation agreement shows that it's taxable in Thailand, then we work out the amount of income you've brought in. Then we can use the common allowances. So everyone receives a personal allowance, 60,000 Thai baht. If you're married and your spouse does not have an income, you get 60,000 baht allowance. And then if you have, say, Thai local health insurance, you can claim up to 25,000 Thai baht. If you are 65 or older, then you also get another 190,000 allowance. So these are the allowances that you deduct from the income. Once you've deducted off the allowances from the income that you've remitted, then we look at the income tax brackets. So it starts out the first 150,000 baht is tax exempt, and then that goes up after the 5 million Thai baht, it goes up to 35% income tax. So it's a progressive tax system. It's not all taxed at 35%. It depends how much you've remitted in and what you've remitted in as well. So how does a revenue know what you've remitted in? Well, it's up to the individual taxpayer to be able to demonstrate what they have remitted into Thailand and what the income source is. So it's up to the individual to file a tax return to show what income sources they have remitted. And if people say, well, have a mixed account, a pooled account, how do I know? Well, you have to use first in, first out method. So Bank of Thailand receives all the data for any transfers into Thailand and reports that direct to the Revenue Department. And the Thai Revenue have integrated AI into a lot of the banks to be able to find patterns as well. So with the new digital arrival card, it's very clear and easy for the revenue to know how many days you have been in Thailand. And with common reporting standards and automatic exchange of information, with the 120 something countries that have signed up, the information's freely shared now. So yeah, as I mentioned, the integration with the Revenue Department and the banks with using AI will change things dramatically here over the next few years. So implications, same as all other tax jurisdictions, to be quite frank. The penalties for Not declaring can be quite harsh. If you have not filed for previous years and you need to file, please do get in touch. We can help file back taxes, and it's not as harsh as it looks. Usually, if we voluntarily file for back taxes, the penalties are 1.5% per month since it's been owed, and the penalties for failing to file tax returns of 200% is if it is found that you've not filed. So if you voluntarily file for previous years, yeah, we can reduce that surcharge just to 1.5%. So what happens if the revenue suspect this non-compliance? So there's a few different ways. You can receive a letter like this that comes across that actually states audit request or information, or to contact the revenue about certain income that's remitted. We've seen quite a lot of these recently, especially if the amount that they have transferred to Thailand does not match their tax return. There's a new department at the revenue just to check this. If you do know you have to file a tax return and you know you've remitted in foreign source income, regardless if there's a double taxation agreement or not, you have to file a Thai tax return and show the tax paid in the other country if the double taxation agreement shows that. It's important, even if you've paid tax in your home country, that you file if it shows that you need to. So you need to obtain a tax ID number to start with. So you don't automatically get a TIN, a tax ID number. You have to apply for one. Two ways. You can either go to your local revenue department and ask for one, and get the queue and fill out the paper form and go through the process, or we can obtain that on client's behalf. So it's a paid service that we have. Then what you'd need to do is file a tax return for the current tax year. This needs to be filed by the end of March, start of April, depending if you file online or not. You can file that yourself at the revenue department, or we have an online service, a client portal where you can file directly with the revenue department. Fill out simple, easy steps to follow, fill out your details, and we can submit on your behalf. Many different filing services available, from Essential package, which is if you've got a simple case, all the way through to Expert, where you need consultations and a detailed analysis. So if you'd like to find out more, please go on our website. Let's go through a quick case study here. So in this example here, I just wanted to explain investment capital gains. There's a lot of misunderstandings about this, and I'm here to help explain it. So how do we work out investment capital gains? So what we do is we have to find out what was the gain percentage for the asset that you've remitted in. So if you sell something, and let's say, for example, in this example, somebody sells £40,000, doesn't really matter on the currency, 1.7 million Thai baht of an asset, and they've made a 40% gain. So that would mean that we'd have to put down on the tax return that they've made a capital gain of 487,000 Thai baht. So that would be the assessable income amount if you sold £40,000 and you had a 40% gain. That's the assessable income. Then we put it into the tax calculator using the allowances and deductions and see how much tax there would be to pay. So for this example, even if you remitted in 1.7 million baht of investment and you've made a 40% gain, in this specific example, this specific person would only pay less than 2,000 baht of tax. So if you'd like to run through your own tax calculator, feel free to get in touch. We can run through that on a call with one of my colleagues who's experienced at dealing with different countries and different situations. So again, there's the QR code if you'd like to book in for a consultation just to go through this, your own situation. I do recommend you download the guide, really useful. And some useful tips for people looking to move to Thailand and have Thailand as their residence is you've really got to keep a good, clear record of what you have transferred or remitted and from what year, and more importantly, what's the income source? Where's the source of the money that's been brought in? Is it pensions? Is it dividends? Is it investment capital gains? Is it a mix of all this? Is it cash that you've had for many years that you can show was in your account before you moved here? Really important that you keep a good, clear record. The revenue can ask for records up to 10 years backwards. So it's really important to focus on the source of the money. If you're here 180 days or more, you need to file a tax return if you have remitted in foreign source income. Really easy to get there for us to get a tax ID number and file on client's behalf. And then also using the FIFO, so first in, first out method. That's really important to look at bank accounts and see where that money's actually from. Do recommend you sign up for that tax alerts because there could be further changes in the future. So as well as our tax guide, we actually have a succession planning inheritance guide as well, which people have found really useful. Yeah, with the online tax filing service, it's very popular for people to use for tax filing and to obtain a TIN. If you do need more time to discuss your own situation, we do have paid consultations as well to go through the details of your own situation. So let's get into questions. There's quite a few that have come in. This is one of the ones I wanted to flag up because this scenario, there's a bit of a misunderstanding about tax years on here. So let's forget the country, it doesn't matter. So wife is Thai, I'm from the UK. That's irrelevant really in terms of the answer. We sell a house in March 26, make a capital gain. We move to Thailand at that time. We buy a house in Thailand in April 2026 with the proceeds of the UK house sale. We then become Thai tax residents in September 2026. Is there any tax to be declared when we file our return end of March 2027? So with this, there's a bit of a misunderstanding that if you move to Thailand, you're only a tax resident once you reach 180 days. That's not the case. If you are in Thailand 180 days, then you are a tax resident from the 1st of January of that year for the whole year. So whatever happened in that year is potentially assessable income if you remit into Thailand anytime in the future. So if you sell an asset in that year, regardless of the location, if you remit that into Thailand, we have to see, is there a capital gain? What does the double taxation agreement say? And how is it treated for tax? So it really is on an individual basis. And it's really important that you get the analysis done, especially if you are, in this example, using the money to remit in to buy a house. It's a large transfer into Thailand. Anything over 1.2 million Thai baht is being flagged and looked at by the revenue department to see it in a calendar year to see, does this match up with the tax return? So it's really important for scenarios like this. Just reach out. Yeah, we're happy to help. So let's go through some of the questions that have come in. Right, let me first of all close this down and I'll put them on the screen so it's easier to read rather than me just talking. Okay. Okay, let's go through some of these questions that have come in while we've been on the webinar. So your tax guide says the Thai government has indicated that that it is studying the feasibility of taxing worldwide income. Well, the point is there's been quite a lot of different rumors and there's a lot of changes to the Thai government. Let's see how this looks by the end of the year for the tax rules. At the moment, we stick with the 2024 tax rules. If there are any changes, we'll let you know. Okay, good question here. You say all capital gains are liable to tax from what year? So let's say, for example, let's assume you are in Thailand, right? And you're a Thai tax resident and you sell an asset. Let's say you sell a stock and a brokerage account. If you remit that money into Thailand, you are taxed on the gains, the capital gains, since you've held that stock, not since you moved to Thailand, since you've held that stock. You can potentially, depending on where you're from, you can use the tax paid as tax credit if you've paid tax, let's say in USA, for example. But the reality is, yes, you've got to really do the analysis on what you're selling and to see if there's a tax liability. Right, here we go. Question. So I'm a US expat living in Thailand full-time. I live on my military retirement and social security, which I transfer into my Thai bank account each month through WISE. Do I have to be taxed on this income? And do I need to file any paperwork, even if it's not taxable? So good question. So for all the US nationals, Americans, or people that have got a US social security income, this is exempt. It's exempt from under the double taxation agreement from taxation in Thailand. Also, military pensions are as well. The point is, you have two options. One, don't file. You don't have a legal obligation to file, but there is a big but. The point is, if you're remitting money from overseas, there's no way that the revenue department can tell what you are sending. So it's up to the individual, but it might be prudent to file a tax return to show that the income is tax exempt so that it matches what you have remitted. And then there's no issue with the revenue chasing up to say, is this foreign income that's remitted and is it taxable or not? So there are two trains of thought. You can either file and show the exemption, and that means that you wouldn't have any tax to pay, or don't file, but the downside to that is potentially that you could be flagged to look at where the source of the money is from. Wrong question here. If I move to Thailand in 26 and spend less than 180 days in the country, can I bring any amount of capital without tax liability? Again, we need a bit more detail to go through this, but in theory, if you're a non-tax resident in 2026 and you remit funds from overseas and it's not taxable in Thailand, yes, you can remit what you would like. It's not taxable asset. It doesn't need to be filed on a Thai tax return. If you'd like more details, good to go through your own situation. Okay. Another one about investment capital gains. So I had money in an investment account since before January 2024, which I believe means it's tax exempt in Thailand, but due to the nature of the account, I can't transfer that money to overseas or to my wife's account. If I then transfer the money to my other savings account and then transfer to Thailand, would it be tax exempt? I don't know what this means by, I believe it means it's tax exempt. If it's an investment account and you have made a capital gain, there's no rule about before January 2024 is all-time capital gains. So if you sell that asset and then remit that money into Thailand, you have to file for the gain that you've made on that investment that you've remitted into Thailand, the percentage. Okay. Okay. If I move to Thailand, become a Thai tax resident, 26, can I stop paying tax in the UK and instead pay tax on what I remit to Thailand? I mean, I don't pay tax on anything I don't remit. It depends. So if you are talking about, for this specific question, if you're talking about pensions, pension income, it's very difficult to get a NT non-tax code to live in Thailand and receive a UK pension. So that won't be possible. If you're receiving, let's say, dividends or capital gains and you're a non-UK tax resident, then you can be a non-UK tax resident and not pay tax on those income sources. And then if you don't remit into Thailand, then it's not taxable in Thailand, but it depends on your own situation. Good question here. Following your CGT question, would it make sense when it's not showing up? Why? No idea. Stop working. Let me load it up again. Technical issue, 1 second. I think it's important to get it on the screen there rather than me just rant. No, it's completely gone. Yeah, so I'll just read them out. Easy enough. So if following on from my CGT question, would it make sense for me to sell my assets before moving? I had held some investments for many years. Again, it depends on your current tax residency and if you'll pay tax in that jurisdiction or where you're from. It's a complicated question, potentially. Maybe it depends on your own situation. One question here about split tax year. So split tax year from the UK is formally moved on the 1st of September. One is a tax resident for all of 2025. One cannot split Thai tax year January to August, non-tax resident, September to December tax resident. So, okay, good question about moving halfway through the year. If you move on the 1st of September, then you won't be in Thailand for 180 days or more in that calendar year. So you're not a tax resident for that current year. You will be for the next tax year. It is possible to be a tax resident in both jurisdictions. And it depends on the statutory residency test, whether you can meet the criteria to have left the UK. So yeah, again, I recommend having a conversation to make sure you get it right, because it can make a big difference if you don't. Question here. Okay, one about cryptocurrency. Quite a lot of questions on this. If crypto assets that I remit outside of Thailand while already being a tax resident there, will I not owe tax on these amounts? Don't really understand the question, but basically if you remit crypto capital gains into Thailand, it's assessable income. With the new tax rules, it's all to do with domestic exchanges, not overseas foreign exchanges. Let's try and get through these questions. So one question about premium bonds. The initial capital for UK premium bonds is after return of original capital. If you remit in the premium bond prices, then it's likely to be seen as income. Okay, one question about LTR. Do recommend that you get in touch if you do have LTR visa. Just come back from meeting with BOI about this specific situation. It's quite complex. It's you've got to make sure that you follow the revenue code for any tax exemptions and that you follow the Thai revenue code for it to be tax exempt, or if it is tax exempt. So it's important that you get in touch to discuss that if you do have an LTR visa, long-term residence visa, how to file, how to use any exemptions that you may be able to use. Question here. Let's look. I'll keep going through them until they're all finished. I'm happy to go through. If the tax treaty says that certain countries tax certain income is taxed in Thailand, but I do not remit that money, in this case, Thailand has the right to tax, but will not because it is not remitted, correct? I assume if you don't remit in the income into Thailand and it's not income, it's not salary or dividend from work conducted in Thailand, it's likely that this is not assessable income and taxable in Thailand. But it's important, again, just check your own circumstances. This isn't tax advice, it's a discussion around the rules. Okay, let's have a look at some more. Okay, good question here about US pensions. So if I remit private pension money from the US into Thailand, am I correct that I only pay taxes in Thailand, but not in the US according to the DTA between US and Thailand? So there's a few things. It depends on your tax residency. Are you in Thailand 180 days or more in the calendar year that you remit in the pension? Yes or no? If yes, then yes, that needs to be filed on a Thai tax return. Once you file that on the Thai tax return and pay the tax in Thailand, then you use the tax paid as a tax credit on your US tax return. So again, we've got webinars on double taxation agreement with the US. And if you've got any questions, feel free to let me know. Okay. Any other questions? Let's have a look. Okay. Question here. I have a UK 6-month fixed term cash account, considered an investment or considered the same as a regular cash account. So the interest that you receive from there is assessable income and taxable if you remit the interest that you receive from there. Same with in the US with CDs or T-bills. If you remit in the income or dividend or yield, that is assessable income. If you remit in the original capital from this, then that's return of capital for these types of structures. But again, before you act, important to get advice. Question here about the explained earlier. I think it's good to sort of clear this up. If I'm planning to move to Thailand in March 26 and therefore will become a tax resident in 26, can I confirm all savings in the bank at the end of 25 can all be remitted into Thailand tax-free in 2026? Again, important to look at your own situation, but if all of those funds you can show were not earned in Thai tax year, and they are, it's not from income when you were working in Thailand or anything like this, and potentially the cash balance at the end of 2025 can be remitted into Thailand anytime in the future. But it's important to get someone to have a look at that and give you an assessment to make sure that you get it right. It's really important. Okay. We're moving as a professional couple and DTV and our expenses will be pooled. Is there a joint tax filing and any specific way those expenses should be split? So if you are both working and you have a DTV visa, for example, the only reason that you would file jointly, it's not like in the US, for example, where you'd file jointly. Here, you would file separately because then you both get the allowances and deductions, and you both get your own set of tax tables to run through. So you can file jointly, but it doesn't make sense in most cases if you both have an income. Okay. Okay, question here. As an Indian national with passive income from India, US, and UAE, if I apply for an LTR visa under the wealthy pensioner category, does it make sense to get the visa and become a tax resident, or just get the visa and not be a tax resident? It really depends on your situation. Depends if you are an NRI or not. Depends if you have tax, if you're a resident in other countries. It really depends on your income sources and whether that makes sense for you or not. This is the sort of advice that my team and the Thai tax consultants can provide to give you real guidance on if that makes sense for your own circumstances or not. So we'd need a lot more detail for one of our qualified Thai tax advisors to give you the information on this. Okay. If 60,000 baht is deducted from income remitted in each year and the first 150 is tax exempt, does that mean in effect that 210,000 baht is tax exempt? Yes, it does. So good analysis. So if you are married and your spouse doesn't have an income, you'd increase that by another 60,000. But it depends on the income source. So it's not just money that you bring in, remember. It depends on the income source. So if it's pension, yes, this is how it works. If it's investment capital gains, then we look at the gain part. So it depends on the income source, what you're bringing in to the amount that's assessable income. It's important to go through the source of the income is more important, actually. Okay. Yeah, one question here, similar to what we had before. I've got €1,000,000 in my account in Europe, 31st of December 25, and I take residence 26. Can I remit that amount into Thailand without paying taxes in Thailand? Any time limit to remit that amount. So if you've got cash from previous years and you can show that it's not assessable income and it's not taxable in Thailand, then, and it's in a cash account, so checking account, cash account, current account, then yes, potentially you could remit that money into Thailand and show and demonstrate that this was from moving to Thailand cash in the bank. But again, rather than listening to someone online and taking advice, I recommend that you reach out and get an assessment for your own situation. It's really important because I think moving to Thailand is one of the key ones where we see it when people make a mistake. They get in touch and they say, I didn't realize that whatever I've sent was taxable. What do I do? And the reality is if they're more than halfway through the year, there's not many options apart from pay the tax. So the point is, it's important before you make any big decision that you seek advice to make sure that what you're doing is correct and, understand the tax complications with your own situation. One question here about crypto. We won't answer this live now. So someone explaining moving onto a Thai exchange, is it considered remittance and taxable? The new crypto tax rules for domestic crypto has only just been published. We are waiting for further guidance from the Revenue Department for how this works in practice for situations like that. We met with them 2 weeks ago, and we will meet with them again later next month to go through this, and we'll put on a webinar specifically for crypto tax in Thailand. So if you sign up for our tax alerts, we'll keep you updated. Okay, that's 39 questions. Let's see one more. If I had 20,000 in a UK ISA, which saw 800 gains, £800 gains in 26, and I remitted 1K in 2026, can I claim that the original money, not the gains, and therefore not taxable? No. So with ISAs, which is a UK investment type, it's the same as if you move to, let's say, Spain or USA. Just because an asset is not taxable in your home country, it doesn't mean it's not in another jurisdiction. This is classed as investment capital gains, and you wouldn't be able to say this is from the original capital. You have to do the calculation and see how much of that £800 gains you've remitted into Thailand. So if you're remitting 1,000, then you've remitted in 5%. So we'd work out that, £800, 5% of that would be the gain amount that you put down on there. So that's how we calculate this. We have a webinar on investment capital gains if you'd like to go through this. Good question here. Are gifts taxable? It depends. That's the answer. It's a very, very detailed conversation to go through this. It depends on your tax residency. It depends what you're remitting. It depends if it's a gift with reservation of benefit. So are you going to benefit from that gift in the future? It depends on their tax residency. And it also depends the amount that you remit and if they are a spouse or non-spouse on the amount that you can remit without gift tax rules. So again, it depends. Really important that you seek advice before just sending funds across. And if people are going to do that and say it's a gift, because if you are going to use that as evidence, if the Revenue Department asks, you need to be able to back that up with documentation and evidence that this was a gift and it's not remittance of income, for example. Okay. Sorry, rephrase. Interest from regular savings account is classified as income. Correct. Gain from an investment, property shares is considered investment. Correct. So a 6-month fixed terms cash account, is it considered income or investment? It's a cash account that's got an interest bearing. So it depends what you remit in from there. That's the important part. Okay, if you do have any other questions, feel free to reach out to one of our team and we can happily explain on the telephone or on a video call. And if you do need tax filing services or TIN, tax ID number, then feel free to get in touch. That's what we do all day, every day. Last question. I've paid capital gains in the UK rental property prior to becoming tax resident in Thailand. I don't really understand the question. So if you remit in rental income, it's taxable as rental income, and you can use any tax paid in the UK as a tax credit. Hope that's question answered. Thanks for joining and have a good afternoon. Bye-bye.